how to pay less tax with property. This video is about how property investors legally pay very little in taxes whilst holding big property portfolios. Hi, I'm Jaco Grobbelaar, the founder and managing director of Prosperity Enterprises. Benjamin Franklin said that nothing is said to be certain except for death and taxes. Tax is such a hot topic that even the Beatles sang about it. You want to get a new mindset when it comes to taxes. Often, people are so obsessed about not paying tax that they forget to make money. So, taxes should always come secondary to making money. I will never forget a mentor of mine, a CFO of a listed company, tell me, Jaco, there's one thing worse than paying tax, and that is not paying tax. It took me a while to realize what he was saying, but what he was saying is that if you are not paying tax, you are not making money. So you first and foremost want to focus on making money, and then whilst making money, you want to determine how can I now pay as little taxes as possible on the money that I am making. When it comes to property investment, you want to run your property portfolio like a business. Remember, individuals receive income, they pay tax, and then they spend what is left. But businesses receive income, they have all of the expenses deducted, and then they pay tax on what is left. So with your property portfolio, you want to make sure that you run your property portfolio like a business, and that you receive your rental income or your income, that you deduct all of the expenses possible, and that you only pay tax on what is left. Governments love businesses because businesses create jobs and they collect taxes on behalf of the government. So, in most countries all over the world, you would see that often a company would pay less tax than an individual would pay. And that is why you want to build your property portfolio in the correct structure, where you've got a company with a holdings trust, holding the shares in the company for asset protection and for estate planning benefits, and build a bigger property portfolio whilst paying less in taxes. Make sure when you build your property portfolio that your structuring is right so that you can pay as little in taxes as possible. What are the benefits of having the correct structuring in place when it comes to tax? Firstly, as mentioned, in a company, you often pay significantly less tax than you would have paid if you get taxed in your personal capacity. Secondly, there's the recording of tax-deductible expenses. I want you to think about it. Your interest on your monthly bond payment that you are paying, your rental agency commission, your levies, your rates and taxes, your repairs and maintenance, your utilities, your insurance, your administration costs, your traveling costs, are all expenses that you can deduct before taxes need to be paid. Then you have accumulated losses. When you have a property portfolio, often for the first number of years, there are losses that are accumulating. Now, if you have an entity and those losses are recorded in your annual financial statements, when your entity starts making profit, those accumulated losses can be written off against the profit, which can result in significantly less taxes that are paid. Lastly, and this is my favorite, there's the maximizing of unrealized gains or profits and the minimizing of realized gains or profits. What does this mean? This means that when you have property and you refinance those properties, you are in effect making a lot of capital available, a lot of funds, a lot of money available that you do not have to pay tax on. And this process can be done over and over whilst your property is appreciating with value, making funds and capital available that will not be taxed, that you can use to pay back loans that you've made to the entity, as well as to expand the property portfolio within the entity. Think about it. When you refinance your property, your bond is going up. Your cash in your hands is going up. your interest expenses are going up. Your net profit is thus going down, and your taxes that you are paying are going down. So with refinancing, you actually make capital available whilst not paying tax on that money. Then there's the primary residence. You can, even with your primary residence, find ways to pay significantly less in taxes. When you have a primary residence, don't treat it like a primary residence. Treat it like an investment property, if that property is an investment property or could be an investment property. So put that property not in your own name, but in your property company, and rent it from your property company. Because when you are renting that property from your property company can earn rental income and then deduct all the expenses, the interest on that property, levies, rates and taxes, maintenance, service fees, and administration costs, and all of those can then be seen as tax deductible expenses. So, in property investment, there's a lot of ways in which you can pay significantly less tax than what most other investors can. If you like this content and you would like to see more of this, remember to like and subscribe. Thank you.